Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hello Lauren.
Hey Curtis, hey everybody.
Hey Lauren, we're talking a lot about investing nowadays with the media attention about the investment markets, and I know we're going to talk a little bit about the five-star funds,
Right.
which I think Morningstar is uses that term for
Yes.
the rating their funds. So we're talking
Yes.
about mutual fund ratings, right?
Yes.
Yeah.
So in my classes recently, I was talking about five-star mutual funds and a study from 1999 which showed that after 10 years they had done very poorly. And you know, Morningstar is a useful service, but unfortunately their star rating service is not useful. Now, I had often thought to myself, you know, in 1999 a lot of the five-star rated funds would have been tech funds and all that sort of thing. So I often thought, well, maybe they did particularly poorly over that time period. But I was incorrect. A recent study came out that showed the performance of five-star funds over the last 10 years.
Okay.
So we're talking now about the funds that were rated 5 stars in 2004. Okay, here was the most surprising thing about the study. 22% of the five-star funds in 2004 don't even exist anymore.
How many?
22%.
Wow.
One out of 5.
That's amazing.
They did so poorly that they were merged or just shut down.
Okay.
So if you decided that using the star ratings was an important way that you were going to use to pick mutual funds in 2004, you had a 1 in 5 chance of picking a fund that doesn't even exist any longer.
22%.
Yeah, it's already gone. And then of the funds that did, you know, survive, you know, it was distributed. There are only 2% of them ended up being 1-star funds. But see, that's deceiving if you don't know that 22% of them already got shut down.
Right.
Then 11% became 2-star funds, and so on and so forth. There was one particular fund, the Fair Home Fund, which I remember from my discussions in internet forums was very, very popular at one time. In 2011, it lost over 30%.
Wow.
But this was 2011, which is not, you know, some spectacularly bad year for the stock markets. It was a pretty sideways year, but that fund did terribly. You know, it had gotten us a very high star rating. This is something I talk about all the time in my classes. When you deal with active management, sometimes they get great results because they're lucky. Sometimes they get great results because they have some extraordinary skill, but more often, if an actively managed fund gets great results, it's because it's taking very concentrated risk. Very specific kinds
Into
of
an
risk.
asset class that's doing particularly good.
Yes, yeah. And so then, sometimes those risks show up.
Yeah.
And then people take their money and take it out of the fund. So this Fair Home Fund is now yet another fund that has had the fund has had great returns for the last 10 years, but investors have had terrible returns. And then there's another fund, the Marsico Fund, which is also a 5-star, Marsico International Opportunities Fund, which was a 5-star fund 10 years ago, which has had positive, you know, about 5% per year returns, or maybe, I think 5.6% per year for the last 10 years. That's what the fund got. Investors have lost about 5% per year out of the fund. Because again, they bought it all, and then they sold it all after 2008, which was a terrible year for a lot of funds, but in particular that fund had a hard time.
Yeah.
So the problem with 5-star funds breaks down into 2 big problems. The first thing is they have very little predictive value.
Right.
And so that's the first problem. The second problem is, even if the fund does okay, the investors often don't do okay.
Right.
Because they don't understand what they're investing in or why they're investing in it. And that's the primary reason why the overwhelming majority of investors should stick to passive investing, should stick to diversification and rebalancing. Because when you're just investing in the asset classes, in the types of investments, you know what you're invested in.
Right.
That's the primary reason why it's a good idea for people like us to invest that way, because then there's not this mystery out there about what are we investing in. You know, are we investing in some Wizard of Oz that's behind a curtain and we don't really know what the person is doing. Passive investing works for a lot of reasons, but that's the main reason why I like it. You can see straight through it. You know exactly what you're doing. Yes, exactly.
And you don't have to worry about the manager shifting into some kind of away from that.
Yes, exactly. Don't have to worry about the managers at all.
Right. Well, yeah. So I guess the takeaway from that, and for our seminars we do for our clients, we call it, you know, don't pick funds based on what we call track record investing.
Yes.
And so Morningstar does their ratings on track record investing.
Yes, exactly.
And so again, that's another indication of why you should not do that.
Yep.
So thank you very much for watching this episode of Erickson TV. We'll see you next time. Bye now.
See you next time.